It's earnings, big earnings week this week. I call it Sweet Week. Sweet Week means that we get all the sweet companies, all the big market cap companies that you and I know so well. They're reporting earnings, but are their options truly expensive? It's said that when you get into earnings season, as certain companies come up to approach earnings, that their options will run up in value and be expensive. And that is the case in almost every situation, but not all. And more importantly, just because an option runs up doesn't necessarily mean it's going to be super expensive and super juicy. Look at some of the earnings that are coming out this week. We got Apple. They're reporting on the 1st. Microsoft reports on the 30th. Amazon also reports on the 1st. Facebook on 7/31. ExxonMobil, that's going to be August 2nd. We've got MasterCard reporting on the 31st of July. We've got Procter & Gamble reporting on the 30th. And Samsung reporting on the 31st. Now, these are the big companies that are reporting, but they're not the only ones. There's a lot of other companies that are reporting earnings. And of course, when I look at all of these companies, are these options expensive? Yes, but are they super expensive that make me want to be a seller of premium? Let's find out. So what I like to do is I like to take all of our optionable stocks. I like to do a ranking. And the ranking that I like to do is I like to look at the implied volatility, the IV. We look at historical IV, and we set that against near money options. And we look at that IV each day over the course of a year. So a year of that is going to give us a couple of things. It's going to give us how low it was in the year, how high it was in the year, and where it is right now. And expensive options are ranked based on how close they are to where they've been in the last year, to the upside. So this is the list that we pulled today. And yeah, you see Gilead at the very top. There's Merck and McDonald's. I have those highlighted. I'm going to talk about those in just a moment. But we also have SOX, MBLY, GEHC, Biogen's on the list, APTV, FND, and rounding out the top 10 is SFM. What most of these, actually, what do they all have in common? Take a look at the columns. So you've got the stock column. We all know what that is. Then you've got the high IV column. That's the most expensive it's been in the last year. So if you look at Gilead, 29.75. Then look at the low. That's the next column, where it's been in the last year. 1711. But look at where the current is for GILD. It's exactly the same as the high IV, which means it's as expensive as it's been in the last year. Same for Merck, same for McDonald's, same for everything on this list. Your top 10 are hitting the most expensive options premium that they've had in the past year. Let's take a look at two of them. The reason I pulled up Merck and McDonald's is because, again, McDonald's reports today after the close. And so when you look at where it is, where's it been just a couple months ago? So in between earnings, you're seeing it down here at the end of May, around 14. So look to the right-hand side of the chart, and you'll see 14. And that 14 is the low and implied volatility. It means the options were cheap at that time. The options were at 28 just Friday, meaning that 14 to 28 means that, is it safe to say that those options, the near-term options with the same time frame to expiration, doubled in value? And they doubled in time value? Yes, they did. So they've come off a bit today ahead of earnings, but still much, much greater than they were just a few months ago. I want to show you one more. Take a look at Merck. So this is Merck, MRK. MRK in the middle of this chart, and I'm looking at the black line. Again, not the candlesticks. The candlesticks are the stock price. The black line is what I'm interested in. That black line shows a low right in the middle of the chart of just below 16. Look where the black line is when you go to the hard right end of the chart. The hard right end of the chart is above 30. That means that you've got, again, something that has now moved up that's near twice its value. This reports at the close of the 30th. And what ends up happening? What's the I'm not going to say it's a guarantee, but what almost happens is that once those earnings report, then we'll see that expensive become cheap, because what is unknown becomes known. All right. So, a couple earnings takeaways that I want to share with you here. Just because something has earnings coming out this week, like the really big names, doesn't mean it's going to be super expensive. When you take a look at the Apples and the Amazons and the Facebooks, yes, they have low points, they have high points, but have they been as expensive as they've ever been in the last year? Right now, no. If you want to find the really expensive, really juicy stuff, you look for expensive options first, then you backtrack and go through each stock and you see who's reporting. And you're going to find most of the folks and most of the symbols that are on the expensive list are reporting this week, but they're going to be the ones where the juicy options are. All right. And the last thing I want to mention is the results that we find in those top 10. I look at selling premium on these. The last thing I want to do with those top 10, those really expensive options, is buy options on that list. Only a fool would buy options right before an earnings report comes out. And only a fool would hold through earnings because, yeah, once in a blue moon, they're going to make some money. But those expensive options, typically you're overpaying for them and you end up giving back a whole lot more than you end up making as an option trader.